So indeed, US interest rates are quite a bit higher in both market rates and policy rates relative to the Asian economies, broadly speaking. This is partly related to the inflation outcomes. As you know, inflation in Asia also went up like the rest of the world in the last 2 years, but they have been relatively more benign, lower, which has also allowed monetary policy rates in Asia, both in emerging markets but also advanced economies, to be relatively lower. Conversely, in the US, because of strong growth, but also some slower momentum in inflation prints, recently markets have now reassessed their expectations of potential monetary policy easing to be coming later rather than sooner. And this is what I understand you mean by higher for longer. So in terms of what this means and what is the impact, one clear impact is obviously the US exchange rate appreciation pressures relative to other exchange rate, be it Asian currencies or other currencies, both in emerging markets and advanced economies. And perhaps the second effect, given that US interest rates do induce global financial conditions, is higher interest rates in borrowing externally. So those are the two effects, and it's clearly a dilemma, because what does that mean? The currencies are depreciated or weaker relative to the US, and sometimes there's also volatility involved. I guess you did not ask, but just a corollary to that, our advice at this point, given this situation, would be to focus more on the domestic economic conditions and the fundamentals, and not to be overly impacted by or affected by or orient your policies towards what is happening with the Fed monetary policy. So in Bank of Japan's case, clearly they have made a historic move recently by exiting from their unconventional monetary policy in three ways. Exiting the negative interest rate, the quantitative easing, and other forms of easing, and this was done in a very smooth way despite it being historic. So our baseline, and it was well communicated, and which is one of the big priorities right now, given all the changes in the global economy, given the shocks that central banks face when they make changes to their policy decisions. It should be well communicated so that the markets understand where they're coming from. And in this context, for Japan, indeed, our baseline projection is for policy rates to go up very gradually, and that would be consistent with both inflation as well as inflation expectations reaching the 2% target and output gap being closed. And in terms of how should they react, this is under baseline, but then again the same principles also follow for them to be data dependent and ready to act. And this is what they have also emphasized in their communication. Japan's economy has slowed because of the one-off factors that were strengthening growth last year from tourism, have now kind of moderated. But at the same time, we expect our baseline projections are predicated on consumption actually playing a stronger role in growth this year. And the reason behind that is, one of them is, of course, the strong wage negotiations that have taken place. We expect now wage growth to actually be positive in real terms, and that should support consumption going forward, regardless of this slowly rising interest rate. And they're all consistent with sort of output being at its potential, and they're being limited to slack. Clearly, there are risks on both sides, and that is why we discussed this at length, also in our concluding statement. Look, again, our baseline projections are for for actually inflation stabilizing and staying at the 2% target in the next year's time. But there could be risks on both sides, and both on the on the upside, but also on the downside, and that is why these are all green shoots. They are very positive developments, but that we need to be data dependent. What I can say is that the depreciation of any currency, and this is true for Japan too, impacts the economy in many ways. One of which is, as you're saying, some disruption when there's volatility, but also there is a price competitiveness effect, and that enables net exports to be higher. There is also an element of Japanese firms and banks that have foreign income, which is stronger, but then of course, as you mentioned before, there is also an impact on consumption because the purchasing power is somewhat hurt. And the IMF team's overall assessment is on the net, on balance, when you take all of these things into account. As you know, the Japanese yen has depreciated relative to 2 years ago significantly. All of these effects have on the net a little positive, overall a positive effect on the economy, and the impact on inflation is relatively modest.